So they'll pay 10 to 5% a year for that bond, and they raise a bunch of money. It's like I'm talking about the millions. Sometimes in the billions, depends how big the company is. So what initially what my kind of role was at that firm was to basically manage the book and making sure each client, so these deals usually, we call them deals, there is about, like say the firm has 5,000 to 10,000 clients. Every single client wants a piece because what happens is when they go into the market, when they go into the secondary market, which is the stock market, they usually pop, which means they get a huge percentage. So a lot of people want to get in at the deal level. What I essentially did is I allocated what client gets what based on certain criteria for the client. So if the client it makes sense for them to have this stock or this bond and it fits their profile, then we allocate it. So I did that for a couple of years, and then the firm actually sold the unit that I was in, which is the wealth unit. So then I moved on to a different firm, it's Bank of America Merrill Lynch. Over there, it's kind of completely different kind of role, but it's within the prime brokerage space. And again, I'll go through all these terms, so if you kind of don't understand, I'll explain a little bit. So prime brokerage, essentially we lend money to hedge funds. Hedge funds, essentially their entire operations come from borrowing capital and leveraging what the client has. So if the client gives them $100,000, they actually can use $1 million of market power, sometimes more, of actually buying assets from that $100,000. So they get that extra $900,000 usually from banks, and banks give them based on assets, which is the underlying stock or underlying bond that they trade against. So at my current role, essentially what I do is, so each client has a certain risk profile as to how much we're allowed to give them based on the assets that they usually bring into the firm. And every single day, based on market data, that kind of changes. So if one of their holdings or their stocks or their bonds or whatever they're holding drop tremendously, they have to actually give us cash to cover that amount that they've lost. Usually doesn't happen. It's like very rare, like once a week. It depends on the market. If the market's going down like crazy, then it's going to be a lot more. But what they do essentially is we monitor. What I do essentially is I monitor what happens on a daily basis in the market and how that fits their profile. And if something needs a market call, I kind of notify the client. This is how much you need to give us on a certain day. By the end of the day, they wire that money cash or whatever. So that's essentially what I've been up to, and I have been working for long. It's 5-6 years after I finished college, and now I'm kind of like in the middle of my career where I have options to actually stay in a role or move on to other types of roles within the bank. And I'll explain to you how big the bank is itself in terms of what they actually do. But before I do that, any questions on my background before I can go into actually finances? Yes.
When you said that the market drops,
Yes.
and if the market drops, then people who invest with the hedge fund would have to pay back money.
No, never the clients. So the clients usually have a holding period in a hedge fund of like 90 days or 120 days before they can actually take money out. So the clients never actually. It's usually the hedge fund themselves that has to supply the cash. So they generate the cash. So what they do is, it's not one firm they work with like 5 to 6 firms. And the assets that they want, for example, let's say I have $1 million worth of Apple stock. I'll put 200,000 here, 200,000 here, 200,000 here as collateral for the rest of my loan. So it's usually, okay, so what they'll do is they'll liquidate an asset, which means they'll sell something in another firm and bring the cash over here if this is the one that has the call, right? And usually they diversify that because if they did it all with one firm, someone will figure out their strategy and their hedge fund will be broken up. So they try to do is they get like 5-6 firms and they do a little bit of the trading every single firm. Any other questions? Okay. So I just put this quick chart together. It's not not like a be all end all. It's just kind of so I'll put half out here. finance itself, when you talk about it, there's different terms that they use in college. There's something called business management, which is really a different function. It's not the same as finance. It's more on the management side of if trying to be a manager and helping people grow within the firm. So it's a different role itself. Just finance, just I'm gonna stick to the term finance. Finance, it really means a lot of things. So what I did essentially is each of the top blue ones, the kind of the darker blue, is essentially a role within the bucket of finance, right? So there's banking, which is traditional banking. When you go to the store here, I don't know, we have not a bank here, Chase or something like that, TD. These are mom and pop traditional banks. And actually this is how finance started, because in the 1900s, I don't know exactly what time, I don't know the history, essentially people needed to start depositing their cash, because when they started moving to cash currency versus actually holding gold, people didn't want to just hold cash in their houses, so it became a need to actually have banks to store this money in. So that's the deposit services. So that's actually what most banks start out as just deposit. So they go to the bank and they give them their money. By regulation, actually, what they're allowed to do with that money is lend 90% of that money. So if I give the bank $100, they can actually lend out $90 from that $100, and they can make money from that. And the reason they can do that is because they actually pay an interest to the client. So the client, let's say now interest rates are like very low, so it's like 1%. It depends on like what bank you go to, but they actually pay out some interest, whatever it is, it's a nominal rate. That interest goes to the client for just holding the money at the bank. And what they do with that money is they lend it out in terms of mortgages, credit cards, also the different kinds of consumer loans, auto loans, reconstruction on the house. These are all loans that the bank actually gives out to clients at various rates. It's not one rate because, so I'll explain to you how an interest rate is actually derived. An interest rate is based really on one rate, which is the Fed rate, which is the federal funds rate, which is what the Treasury sets out. Now it's about like 1% or so. So that's like kind of the base rate, and then what happens after that is they attach each individual client's the risk profile. So if their risk is, if I'm a very good borrower, they'll give me a lower rate. If I am a so-so borrower, they give me a higher rate. So the rest of that rate is depending on the risk profile. So they get, let's say X, they get 5% per year incoming. And outgoing, they only have to pay 1%. So the spread between those rates, so the difference between the two, is how the banks make money. And that's really across the bank, across the board, is really the spread between two rates is how banks make money. So in my business, we lent to the clients the prime, like the hedge funds. We rent to them at a certain rate. We actually get the money from the corporate bank, which is the banks that lend out to regular people, at a certain rate, and we make the difference between the two. So that's traditional banking. It's kind of split into two. There's consumers, which is just me and you walking down, and then there's business banking. That's kind of a little bit more complicated because there's different types of loans, different depository services over there. But it's essentially the same thing. It's deposit services, lending, and paying. Payments is a new thing, which is credit cards, and providing the service to actually pay via credit cards. So same type of thing. These are all services that the banks make money in, but essentially what they make money in is the difference between interest rates. Okay. Next thing, this is where I know a little bit more. These next two topics. So capital markets. Capital markets within a bank generated when companies needed essentially to raise money at a very public level. So, for example, investment banking, and I'll skip just kind of one by one. Investment banking is when like a company, let's say, I don't know, Torah College needs to actually raise money to fix their building or fix something like that. So let's say Torah College was a multi-billion-dollar corporation, and the bank really can't offer them a good enough rate or a large enough loan to cover all their expenses. So what they'll do is they'll go to the market and say, hey, I'm willing to sell either a debt, which is I'm taking a loan from the general market rather than from one bank at a certain interest rate, and I'm going to pay that every single year, every single quarter, whatever the terms on that rate is. And what they do is they go to a bank, an investment bank, to actually help them get that loan, because they couldn't go to the market themselves. They actually need to go to a bank and the bank facilitates the transaction. Another reason why they go to investment bank is usually investment banks have wealth management arms, which is I go to that, which is basically clients that invest money. It's a lot easier to sell within their own firm rather than sell to the general market. So that's another reason why they go to investment bank. And then a couple other these are all functions within it that help that investment bank. So research is just analysis. They look into all companies, public and private, as to what they're worth, and then I don't know if you heard of something called a target, a stock target, or it's basically what a stock is worth based on their analysis. And every single investment bank has their own research department, and each one puts out their own target. So the targets can sometimes be very wide-ranging because each one uses a different model how they generate that actual target. Trading is essentially they actually trade on the market. So they go to the stock exchange. Each one has their own desk where they facilitate trading between clients. A lot of trading today has gone electronic, so it's becoming less and less as of a money maker. But it's still a big piece of what banks do to generate capital, and they don't generate here on interest rates, they generate here on fees. So whatever they charge a client a fee for actually placing that trade. And there's different types of firms, there's discount brokers and big banks, and they all generate different types of fees. Corporate banking is treasury. What that is essentially is when a huge conglomerate like GE, they have extra cash, they don't go to a regular bank to deposit that. There is a special bank that they go to because they have billions of dollars, and when they need to move money, they don't want to go through the process of going through the approval for every $100, right? So they need a bank that can work with them on a if they need to move them $500 million, $500 million one day, and something like that. So they go through something called corporate bank. Functions generally like a regular bank. It's just a lot easier for them to move money, which is why they go through a different department. Prime brokerage is where I'm at right now. I'll explain to you, it's basically we lend money to hedge funds and we facilitate their trading. One of the things that I mentioned before is once they actually come to us, they actually have to trade with us. So not only do we generate interest revenue, we generate trading revenue, which is when they trade with the bank, and usually hedge funds trade a lot. Each time they trade, there's a certain fee, and that fee comes to the bank. So, which is one of the prime reasons why hedge fund clients usually get much better rates than the traditional market, is because they trade so much. So we welcome them to the firm just to trade, and that helps the firm's profitability. Okay, so I'll move on to wealth, and I'll leave time for questions once I'm done with the first half, and then I'll explain to the bottom half. Wealth and asset management is when people have extra money that they don't want to just leave at the bank and get 1%, they want to earn a little bit more on that. So there's like a million different avenues of how they can actually put that money and where they can put that money to generate a return. I'll go through all of these, but essentially what it is they're trying to earn money on their money through different methods, okay? So traditional wealth is something called self-directed. So self-directed is a person, it doesn't have to be at a firm. A person can decide, I want to make an investment in a private business. I want to make an investment in my brother-in-law's company, my brother-in-law's store, whatever it is. These are investments that they make on their own. It could also mean that, hey, I think I'm smart, so I'm going to invest in the market and I'm going to buy some certain stocks. So these are all based on what the client themselves or what the customer themselves wants to do. Manage means they give their money to somebody, and that somebody manages their money for them on their behalf for a fee. It's called a management fee, and the fee is usually like 1-2% on a very basic firm. Hedge funds have a different structure, but about 2% a year on their overall capital. And hedge funds actually make money on what the profits are. So if they generated 50%, they get like 30% of that 50%. Financial planning is another part, which is they don't actually help the client invest, but what they do is they create a profile for every individual client based on where they are with life. So, like for example, me, I'm kind of early on in my life. I can afford to invest in a lot more aggressive stocks and different kind of form of investments where the risk of loss is much higher. So he will create a profile of all the things that I can invest in based on my age range and where I am in life. Also kind of how much extra funds they have, and all those kind of things. So the financial planning is its own kind of field, and it usually works hand in hand with managers. The manager actually does and executes on what the financial planner puts together, and the financial planner puts the plan together. The next kind of part is these are all funds, and these are all really under managed as well, because they basically give them their money, you give them your money, and they invest on your behalf. The reason that they're all split out is because they all have different, it's kind of called objectives. So a mutual fund, for example, they set out a certain policy as to what they can and cannot invest in, and they have to abide by that policy. It's really very little wiggle room, and they just buy and sell stocks, bonds, all kinds of publicly traded securities. They don't really go into private, which means it's somebody personally owns it rather than it's on the stock market. And most of these companies offer, the huge benefit is that they offer very low fees. So they're like under the 0.5% sometimes on how much they charge per year. And for retirement clients, which is very key, so a lot of people have a 401k, or I don't know if you heard those terms, an IRA, which each are retirement vehicles that the government set up, which grows tax-free. So the less fees, the better for the overall return. So for example, every 0.5% equals to like an average portfolio is like $100,000 to $200,000 at the end of the life of the investment. Hedge funds is a really very wide space, and I could spend the whole lecture just talking about you guys. Hedge funds really, basically, you're giving a person latitude to invest in almost anything that they seem fit so they also have some guidelines, but essentially you're telling them, here, take money, you make as much money as possible for that money. And these guys usually have a much higher target than what mutual funds. So mutual funds try to make, let's say, what the market makes, let's say on average 6-7% a year. They try to match that, and if they're a little bit higher, they're doing a great job. But that's kind of the mutual funds role. Hedge funds, on the other hand, they try to make 50-100% return per year on their money. Not that it's possible, but that's kind of their aim every single year, is to make as much money as possible. The reason that they want to do that is because they don't actually just get paid on the amount of money that they manage. They get paid on percentage of the profits. So the more profits that there are, the more money that they make. So hedge funds is a lucrative business, but it's very hard to beat the market. I'm sure you'll learn over the next couple of years. It's on average, most of these guys do at or a little bit above the market. That's the bell?
That's the bell.
Okay.
Okay. Selim's going to talk for a few more minutes, then you'll ask your questions.
Yep.
You're going to go back to class at 10 to 9. Okay?
Okay. Okay, so pensions and endowments pensions are for retirement. They're company-sponsored retirement plans that they give at the end of the life of, let's say, at 65, whatever it is. They give the employee money. So these guys are huge in terms of how much money they actually have to manage. It's just because it's a pool of people, so it's all in one fund. Endowments is usually for colleges and private institutions that are nonprofit, and they have extra capital that they need to invest in. So I'll just kind of start going through this quickly. So private equity is similar to how hedge funds and mutual funds work, but they actually specifically invest in certain vehicles. So real estate private equity real estate is when somebody, like a group of people, saying, hey, I want to form a partnership or whatever it is, the actual company type doesn't really matter, and we want to invest in this type of real estate. Whether it can be commercial, it can be retail, or it can be residential buildings. And so their mandate is essentially, I just want to invest in real estate and I want to make money in this type of real estate. Venture capital is same type of thing, but they invest in startups. So they invest in young private companies. And this is kind of getting a lot of big today because of all when you invest in Facebook very early on, and you have huge return on capital if you're at the venture capital level, but their risk is a lot more because most of their companies actually fail, and it's very few of them that actually hit it very big. Oil and gas, same thing, they invest in just in oil and gas, but most of these things are essentially, there's different types of private equity, and they invest in one vehicle outside of the stock market. So that's why they're called private equity. Fund of funds is also a different term. Basically, they're a manager that's in charge of buying different types of mutual funds, hedge funds, and they invest and they slice it up based on what kind of they see fit. So that's why it's called fund funds. Insurance is also actually part of finance, but it's a little bit differently. I'll kind of go through just very quickly. I don't know much about it, but I know a little bit about it just to cover it. So there's life insurance, property and casualty, which is essentially auto, home, and all those kinds of insurance, and health, and which is medical, dental, and vision. So what these guys actually do, this is what Warren Buffett, I don't know if you guys kind of heard of him, but this is actually how he started his business. He early on bought a company called Geico. And the reason that this is a really profitable kind of way to get into wealth management and investing is because what insurance essentially is I want to minimize my risk of a certain kind of life event or my property. So what I do is, okay, I have let's say $2 million home, I want to actually insure that in case there's a fire or something like that. So what the insurance company does is they actually analyze based on where they live, based on how many people actually place claims. This is the actual risk that this person's home is going to be on fire. So they take that risk, they put that into a dollar amount per year, and then they charge a client a little bit higher than that. So that's how they make their money. So when the client's paying for, let's say, 20, 30 years and there's no fire, that money has to go somewhere, and it's called free float. So insurance companies are allowed to do whatever they want with that money, essentially. So what Warren Buffett did specifically is he took that money and created his big empire. He started investing in other firms with that free flow capital. So it's a great way to kind of get into, if you're interested in actually managing money. It's a great way to actually earn capital without actually having to get client money. It's your own capital. You have 100% of the profits, and it's all yours. I don't know much about it, but that's kind of just a little bit of a kind of snippet. The bounded functions are also finance, but the top is how the bank makes money. The bottom is what they need to support them to actually do what they do. So accounting is its own field. There's different types of accounting. There's tax accounting, which is with the IRS, just to make sure that they actually pay their taxes per year. Managerial accounting is internal accounting to see how much a specific project that they want to take on. So if Apple wanted to invest in a new product, how much is that product going to actually cost them versus how much they're going to make over the life of the product. And they actually do this accounting, and they do these estimations and then they present saying, is it worth it for us to actually invest in this innovation? Financial, that's the second bell? So the financial accounting is internal accounting to actually report numbers out to the market. So every single quarter, they're responsible to report how much they made, how much they lost, and what their expenses are. So that's what financial accounting. It's completely different from tax accounting because they use different kind of methods to actually generate their information. Supervisory is, and these are just really it's kind of government functions and internal functions. Compliance is to make sure you're complying with regulations. Audit is internal procedures in terms of a bank. Each has their own policy as to how they can and can't do things. So the audit is in charge of making sure everybody does that. Risk is making sure the bank doesn't take on too much risk in certain fields. So there is market risk, there's credit risk. And I won't go too much into that because I don't really know too much, but I know that it exists. Operations is what helps kind of the bank run on a day-to-day. So trade support to actually help both kind of people to the bank to actually trade and clients outside the firm. The finance operations to help loans go through. These are finance officers that actually process the loans. Customer support is just general people who answer the phones for both internal bank employees and outside the bank. And then there's a whole bunch of general operations like the building services, all kinds of things that help the bank actually run on a day-to-day. Next two are also support functions. They don't really need to have a finance background. It's technology and human resources, both crucial part to how a bank runs on a day-to-day. Especially technology becoming a very big thing because if you're still stuck 20 years ago, the bank itself is not going to survive another 10 years because just how the market's moving. So that's the world of finance, and now I'll open it up to kind of questions as to.
I just want to say we're very grateful that you're here today. He's a wealth of information. We're going to beg him to come back on Career Day. Also, in addition, I was going to say that Selim makes time to go to Rabbi Prague's class at night that he formed, which is a very special part of Yeshiva of Flatbush. You bond with the teachers here, and then when you're out of school, 5 years, 6 years, 7 years?
Out of high school?
Yeah.
I don't know, almost 10 years?
Almost
I don't
10
know.
years, okay.
Yeah.
Still going to Rabbi Prague's class in Sharetziel. All right, so we'll open it up for questions. You have a very beautiful thank you for bringing the schematic here so that they can have an overview. Go ahead, let's start with Sunny.
Okay,
You
so-
say your name when you ask your
My
question.
name is Sunny Carey. So you said that you were the broker basically between, like when hedge funds want to borrow money from a bank, you're sort of the middleman who gets a lower rate from the bank and then gives it to them at a higher rate.
Yeah, so it's not really a broker. So the prime brokerage firm, part of the bank, is itself, it's its own bank essentially. But we don't get money from customers. Our actual capital comes from the corporate bank, which is the TD bank down the road. But they have Bank of America, which lends the capital. And they supply their capital at a certain rate, and then we lend to the clients at a certain rate. That's kind of how it works.
So why don't the clients just go directly to the bank? Why do they go through you?
Because they can't. There is no, the bank, the corporate banks don't usually lend to hedge funds. They're set up a specific unit just to lend to them. They can go get a loan, but it's not going to be as good as the loan as the prime brokers. Because the reason prime brokers give a below market loan is because the clients trade a lot. And they generate that revenue, so so the bank says, okay, I'm going to get this much money from the trading revenue. I can afford to not get as much money from the interest rate revenue. So it's usually much more on the trading side. So they can actually give them below market rate than with the. But either way, the bank is internal loans are much cheaper than what the hedge fund is going to go to the street to get a loan from.
And also one more question.
Sure.
You said that mutual funds only invest in private businesses?
No. Mutual funds do public most of the time. Public. Yeah. Private is the private equity side. Private equity, they typically invest only in private businesses, and the funds most of these funds usually like 90% invest in publicly traded because they have a quick turnover in terms of how they need their capital. A client in a mutual fund, I can sell a mutual fund any day. So when I take out that money, they actually have to sell something to cover that money. So they need to be in public businesses because they need to turn over the capital very quickly.
Other facts. You said for the hedge fund they try to aim to get between 50 and 100%, but how much do they actually make, generally speaking?
On average, they do a little bit above market rate, so like 7 to 10% on average. But there are funds, and then there are stories. You can go look up kind of their information. Every year, there's 1 or 2 or 3 hedge funds that really perform really well. They do 50 to 100%. The good thing about them is their transactions are private, so you have no idea how they make their money, which is why a lot of them, after a couple of years, if they don't report out at the end of the year what they actually put their money in, they'll go bust because it's all fictitious. The numbers are not really real. They're just creating like kind of a Ponzi scheme almost. But yeah, so their entire trading scheme is private, which is what they're being paid to do. They're being paid to trade above what everybody else can do for them. Which is why they get paid more than everybody else.
Yeah, I'm showing Natasha. Can you explain how the free flow money works for like the number?
Free flow for insurance?
Yeah, where it's 100% of the money and then you just like invest it.
Yeah, so this is an insurance company. So it's not a banker himself. It's just the insurance company. When they create revenue from insurance. So if, for example, Geico has a bunch of auto loans. So what they see is, I know every year on average, I pay X amount of money. So let's say I bring in $1 million of revenue every year. I know for a fact there's going to be at least $200,000 worth of accidents every single year. But I'm getting $1 million, so I still have about $750,000, whatever the difference is. I have that amount of money it's not profits, because you actually still have to hold it in case there is more, like for example, there's a big hurricane and they have to pay out all those money. So they actually have to hold a certain percentage of it with them. But the rest of the money, let's say for half of it, they actually, now it's cash to them that they're free to invest it anywhere. It's not that they can take it as profits and pay it out to their shareholders or pay it out to the owners. They actually can invest that money in anything. So, but if you own the company, which is what Warren Buffett did, he can invest in anything he wants, and all that money really is his. So at the end of the day, he created his $80 billion, I don't know what it is now, conglomerate based on Geico. Not solely based, but kind of that's how he got a lot of his capital flow. Okay.
I'm Tayo's here, and for corporate banking, is it basically like banking for people who want to make like big loans and
Not people, it's companies, big companies. So that's the difference between corporate banking and commercial. Commercial usually is like middle to small business. People generate under like $50 million of revenue a year. They usually go to commercial. Corporate banking is like top 500 firms in the world. Like they have billions of dollars and they need capital moved at a kind of moment's notice. So banks usually have a lot of restrictions as to how much they can move at a certain time, and they need to get approvals. What commercial banking allows them to do is preset the amount. Okay, I can move easily $500,000 or $500 million without anybody's approval, just at a request of a certain officer at the bank or at that firm. Any other questions?
What do you recommend that students do if they want to get into the business field? Like right now from high school, what should they be doing?
So I didn't, when I was you guys, I had no idea that I would be here, right? So like it's hard to say. I understand there's some interest in it, and I was interested in finance. There is a load of information available online. You can learn everything I learned in like a year, just taking online courses. The actual part of the job that I do, that you have to learn on the job, but in terms of the overview, every single big college in the country, like Harvard, Columbia, Yale, all these colleges offer online courses for every single course within finance that they give at the college. MIT, I know, has a huge amount of courses just specifically in finance, and not to say to take the entire course, but you can actually read about what they offer, and if there's something specifically that you're interested in, you could actually start planning now and say, hey, I want to do this when I'm in college because this is something that I want to get into. In terms of the actual work, it's from what I learned, it's key just to get an internship that's finance related. Better at a big bank because it kind of looks better when they.
How did you get that? How did you get it?
So in junior year, I just started applying to a bunch. So there's like a college guidance office, and I just started applying to a bunch of roles. And you go on interviews, they like you, they take you, and it's kind of they look at your grades and they look at that stuff. But it's really a people's business. No matter what field you go into, it's not all about what you actually your marks are or what your grades are. It's really how good you communicate with other people, and that is what they kind of base their evaluation on. Because at the end of the day, they're not going to remember that what you had on a piece of paper. They're going to remember their interaction with you. So that's how they hire you.
Do you find these internships on your own, or did college guidance?
College guidance helped me, and then they gave me the resources to go look, and then I just started applying to a bunch, and I got one, and that's all I needed. And then after that, it was just doing the same type of thing when I actually wanted to work. And then once I got something, I kind of stuck to it. And then after that, especially in finance, I don't know about other fields, once you're in it for a couple of years, you're going to get recruited everywhere because there's people move around a lot now. No one stays at the same firm. So like all the time you're going to get calls, hey, can you want to come over here for this role? So I kind of hear what they have to say, but depends on the role. If it's like a crazy role with a kind of what I want to do in the long term, then I'll kind of hear a little bit more, but most of the time I kind of ignore it. It's just, finance especially it's I don't know what percentage of GDP it is, it's a lot because if you go to the city, there's like a whole district just that does finance, and on top of that, every single company has a finance department which does specific functions, so it's a very big field that I don't know how many people go into, but it's probably one of the most studied courses at colleges.
Thank you. Amazing. Thank you so much.